Hello, everyone. This is David Schlossberg with the Assured Concepts Group. Thanks so much for jumping on our channel to watch this video. We're going to be talking about President Biden's recently proposed 2025 budget. Now, this is what's known as the Green Book. It just came out. I have a copy of it here on my computer dated March 11th, 2024. It's a few hundred pages long on things that Biden and his administration would propose to effectively run the country next year. A lot of these proposals are tax changes, which is why I'm so interested in reading through this proposed budget. Because these tax changes, while they have kind of a mountain of things that would need to overcome to actually become law, they give us the best glimpse at what the future of taxation could look like. And they help us stay 2 steps ahead of what these policy changes could mean for our clients, particularly our high net worth clients and ultra high net worth clients. So what I want to do in this video is give you a quick summary of what President Biden is proposing in his budget. And again, I stress the word proposing because it would have to pass both the House and the Senate. It would have to be bipartisan. And there's a lot of things that'll change between when an idea goes from a budget proposal into actual law. But again, it really helps for us to be proactive at thinking about blind spots or areas that we need to consider when we're doing advanced planning for our high income and high net worth clients. And so I want to go through some of these examples of things that really stood out to me reading through these few hundred pages of proposals. The first one was that there's a big section that President Biden titled Strengthening Taxation of High Income Taxpayers. These were a whole bunch of proposals that would really impact many people that are earning over $400,000 a year, married filing jointly, and about $200,000 a year if you're a single filer. I'll just kind of read through examples of things that this administration is proposing, and that gives us some insight into what we might need to be talking about with our clients as this might impact their financial future in their situation. The first one is any clients that are small business owners. Typically, a small business owner is going to have a pass-through entity. That could be a sole proprietorship, maybe a partnership, an LLC, or an S corporation. So right now, any income distribution from that pass-through entity is not subject to the 3.8% net investment income tax or Obamacare tax that it was known as when President Obama put into action several years ago. Well, what we're seeing in the proposal is that President Biden wants any of that pass-through income from those businesses to also to be subject to that 3.8% net investment income tax for anyone who's over between $400,000 and $500,000 of adjusted gross income, married filing jointly, that is. He's also proposing an additional 1.2% Medicare tax increase for anyone over $400,000 of income, married filing jointly, an additional 1.2% increase on that net investment income tax. So that would take the Medicare tax and the net investment income tax from about 3.8% up to about 5%, a pretty meaningful tax increase, and he would apply to any of that pass-through income that's occurring. He's also proposing that the top marginal bracket go from 39% to 39.6%. Now, that doesn't seem like a huge jump. You might be saying, Dave, that's only a 2.6% increase. But currently, that top 37% bracket doesn't kick in until somebody has taxable income over $700,000 and a married filing joint tax status. What this proposal would do is any married filing joint tax status of anybody earning over $450,000 would now be subject to that 39.6% tax. So it's not just the bracket that's going up or the percentage that's going up, it's that the income is getting compressed. So you don't have to have those really high incomes of over 700,000 to hit that top bracket. Now, anyone over 450,000 would hit that top bracket. There's huge changes in the proposal to the way capital gains tax works. So this is if you earn your money, then take that money and pay taxes on it. You invest your after-tax money in stocks, bonds, mutual funds, real estate, cryptocurrency, business interest, and hopefully you earn a gain in that investment over time. And then you sell and realize that gain, you pay another tax. That's called a capital gains tax. It's just on the amount of appreciation that you've earned. Today, it's preferentially taxed, either at 0%, 15%, or 20%. Well, this administration is proposing that for anyone who has a total income of over $1 million, any capital gains be treated at ordinary income tax. So that would be the top rate of 39.6%. So if you have capital gains and you realize a large gain in a year, or you have high income, you would go from paying a top rate of 20% on capital gains assets to a top rate of 39.6%, plus add that net investment income tax of 3.8% or 5% on top of it. So you could easily be at 43, 44, 45% tax rate instead of the top rate today on capital gains of 23.8, which is the 20% capital gains tax plus the 3.8% net investment income tax. So this has big implications for people who have capital gains exposure potentially. In addition to that, they're proposing that the gift tax is changed for when people gift those appreciable assets. Maybe you're gifting it to a charity or a donor-advised fund. Not too many changes there, but if you're doing intra-family gifting, there could be recognition of tax at the time you gift, as well as at the time of death. So right now, if you were to hold an investment in a post-tax account, and it's got substantial appreciation, and you were to pass away, your beneficiary would inherit that asset today, income tax-free. But under the new proposal, that unrealized gain would be taxable at the date of death. It would be an elimination of what we know as the free step-up in basis. Now, in the proposal, they're sharing an exemption of about $5 million. So that's nice. But again, for some of our ultra high net worth families, that could still create a new large tax exposure that needs to be accounted for in your estate or legacy planning. They're also imposing a minimum tax for the really wealthy, anyone over $100 million, a 25% minimum tax that's on both earned and unearned income. So this is like a wealth tax. Again, the jury's out if this is even constitutional, but again, that could be an enormous tax change. I think unlikely that it'll happen, but you never know. Things that would impact our everyday high income earners is that they want to limit rollover and conversion options to the Roth account. So if you're over that $400,000 to $450,000 of income, they want to eliminate your ability to convert to a Roth account to build tax-free money up forever. They even want to eliminate some of the advanced strategy that we utilize, like a backdoor Roth conversion for high income earners. So that can become a big deal. That gives us a window where maybe we might want to be more proactive about Roth conversions now, while we know the sun is shining and we can go and make hay, because if Congress eliminates the ability for high income earners to do Roth conversions in the future, that could eliminate a huge planning opportunity to build tax-free wealth for you or your family. They want to expand some of the child tax credits. That's good, of course, for those with kids. A lot of these taxes on the high income earners are going to be able to support some of the increased tax credits for things like the child tax credits or tax credits for lower income individuals. They want to make permanent the Inflation Reduction Act health insurance premium tax credit. So again, that could impact some of our clients who are retiring early before age 65 when Medicare kicks in, and they need to go to the marketplace for their private health insurance. That allows them to be able to receive more affordable health care, and that's a good thing. Again, there's some really advanced income planning to be able to maximize those tax credits for our clients that are retiring early. They want to change around the annual gift tax limits and exclusions. So right now we can gift up to $18,000 a year to as many people as we want. They're proposing to change that to an annual exclusion of $50,000 per year. So that would change around a lot how we do gifting or fund advanced estate planning techniques. They also want to eliminate the generational skipping tax exemption. That could again impact some of the trust work that we do for estate and legacy planning. There are proposed changes to GRAT rules. That's grantor retained annuity trust, and what happens to the GRAT once the GRAT term is expired. They want to tax carried interest as ordinary income. That really only impacts hedge fund managers and some other people that have been able to really structure their income as carried interest. They want to repeal the deferral from like-kind exchanges and limit it to $500,000 to $1 million per year. That could have massive implications if you're a real estate investor buying expensive rental properties. Last but not least, a proposal for 100% depreciation recapture as ordinary income. Again, a huge impact to anyone who's buying real properties or real estate investing. So there's just a lot of these things that impact high income earners. There's also some big changes for corporate taxes. A proposal of going up from the 21% rate to a 28% rate. There's a proposal to implement a 4% excise tax on share buybacks. We know from an investment management standpoint, share buybacks have been very beneficial to the stock market in driving stock prices higher. That'll be interesting what impact it might have on stock market returns. So again, you can see there's a whole bunch of proposals. And the reason why I feel this is so important is that we as an advisory team, working with our high net worth and ultra high net worth clients, want to be proactive at what public policy risk is out there. Which of these laws actually have a chance of getting bipartisan agreement and implemented into law that could impact your financial future. You know, you've heard many times me say on these videos that it's just about analyzing your situation today. It's not just about analyzing your situation today, but it's about looking out 5, 10, 15, and 20 years from now, thinking about your lifetime of taxes. These things are such a big differentiator in how we work with our clients. It's not just about maximizing your situation today, it's looking into the future and trying to apply some of the insight that we're given through these potential changes to help maximize your situation. We'll certainly keep you informed as we learn more as Congress is meeting and they're throwing around some of these different tax changes and how they can impact your financial future. Don't forget to subscribe to our podcast and reach out to our team if you have any questions. At the time of delivery and of subsequent publishing, information was deemed reliable, but is subject to change, of course, and nothing yet that we're talking about has yet passed into legislation. So if and when it does change into legislation, or as some of these things become hotter topics, we'll be sure to let you know. Thanks for listening today. I'm Dave Schlossberg, signing off for the Rest Assured podcast.